Alrighty, folks, it is my great pleasure to bring on the boys from Convoy Home Loans. We have Dustin now. Jonathan is parking his car. He will be on momentarily. But I thought we should talk about what happened in the mortgage market in 24. I think we can talk about what's coming in 25. And as always, on all of these lives, you can ask your question. If you would like to ask your question, you can either A, raise your hand, and you do that by going to the bottom of the screen, and there's a little, what do they call it? Oh, it's in the more, oh,
The
tools.
man, the myth, the legend showed up, by the way.
There he is. Oh, the react. You
Oh,
click on the little heart. It says react. You can raise your hands there. Or if you're shy, you could put a question in the comments, and first come, first serve. I will answer those comments as they come in. So Dustin, why don't you first off just introduce who Convoy is, you yourself, your partner, Jonathan. We'll start with just a quick bio for the folks in school.
yeah, Convoy. John and I started now 4 years ago. We focus mainly on non-QM. We can do it all with the conventional, but our niche and our, I guess you would say, our claim to fame is being your, real estate investor's best friend. Everything that a real estate investor would need to do, DSCR, fix and flip, ground up, bank statement. That's where we come into play.
Yeah, and again, we've been doing work together. Gosh, 2.5 years. Has it been that long? Where you've been a part of the One Rental at a Time family? Is it about that long?
I think so. Maybe three,
Maybe longer,
at
yeah.
least 2.5 for
Yeah.
sure.
Yeah, it's been pretty wild. So we're going to start off with a right turn. We'll get into 24. We'll get into 25. We'll get into question and comments from the group in a minute. But we just got the second of three inflation reports this morning, PPI being the name. PPI came in hotter than expected. I would say really hot. I've also had some economists calculate PCE, personal consumption expenditure, which is our third inflation reading, which will come out after the Fed meeting, which is also going to be hot based on their math. We also have a Fed watch tool that says 98% chance of a rate cut. Where I sit, rate cuts are already baked into the rate sheet, but I'll let you guys answer that. But here's my question. What happens if the Fed does not cut rates next week? I'm guessing that shocks the market, but you guys are in the business. What happens?
I mean, rates are going to shoot up, right? Mortgage rates. Everything is pointing and obviously a lot of the banks are across the countries, like worldwide are cutting, right? And I think that everyone in the theme of cutting rates despite inflation is kind of what everyone's kind of hoping for the Feds to do as well, right? Um, and if they don't cut rates though, because like you said, mortgage market has already priced in basically the full year of cuts, right, up until this point in the rates. If they do not cut rates, and even if they seem, hey, we might not even cut rates, and maybe we hold off in 2025 for a little bit. If those are comments that come out, then mortgage rates will shoot back probably to where we were in July of this year. And maybe, who knows, there might be a world where mortgage rates potentially touch the bottom of where we were back in October of last year.
Hmm. Yeah.
Yeah.
Again, my audience knows this. They watch the daily financial news. Like I talked about it this morning, the inflation appears to be getting worse, although we have some stuff in our future that might make it to get easier. But a 0.4 increase in PPI month on month and a 0.6 miss is bad, right? It doesn't give you any warm and fuzzies. But we also have a job market that is at least 3 weeks in a row starting to show signs of cracking, right? The weekly unemployment claims popped to, I think it was 240 or 245 this morning. And, really quickly, guys, the Fed might have to make a choice. Inflation, jobs. And unfortunately, the tools that the Fed has today do a horrible job of fixing inflation and fixing the employment market, because you cut to do one and you raise to do the other. things could get really, really messy for the Fed next year. Is that fair?
Yeah, no, I think you nailed it right on the head, right? Like in order to be able to fix what the Feds have in front of them right now, which is, a weaker labor market and higher than expected or higher inflation, right? They can't pull the same levers to fix both, or they can't pull the same lever, right? And that's the problem that we're going to run into, and why I think you've said it and we've said it. The Feds really shouldn't be cutting, next week, even though it's a would you say 98% chance according to CNBC market tool.
Yep.
But that's why we keep saying on the show, and it ties back to our theme that we've always said, which is if you like it now, you lock it, because there's nothing right now that I firmly believe with the reports, especially with Trump going in January, that we're seeing the true picture of how our economy is really doing. That Trump pump's going to be in full effect.
Yeah. Again, when I think about what's potential in the first half of next year, deregulation, all of these other things. And let's just be clear. I mean, you're already seeing it in consumer sentiment numbers. You saw it in this small business report. The last two economic reports that I don't think got enough attention was there was a small business survey talking about what small businesses are doing, and it went up like 9 points. It's above 100 now. And then there was a consumer sentiment survey that came out, and it had something like 40% of people think their future will be brighter in a year, which is like the highest in the last 4 years or 5 years. And dude, I've talked to mortgage brokers and real estate agents, and all of them are saying me activity in December higher than November and higher than they expected. So the vibe shift has been real. The Trump pump is real. And I don't think the Fed could be cutting rates in that environment. It just doesn't make sense to me.
Yeah, and it goes back to so many conversations that Dustin and I have had going into the election, and then the effects of what people thought the election would do, which is, hey, once Trump gets elected, rates are going to shoot down, right? That was their thought
That was their bet.
process.
Yep, that was the
Yeah,
bet.
and obviously we don't know the full effect of what will happen, but the truth of the matter is his policies are more inflationary this time of around, and inflation doesn't go along well with mortgage rates in terms of, having a hand-in-hand relationship. So I think that obviously mortgage rates are here to stay longer. We have talked to so many people that have said, I'm just going to wait a little longer till 2025 to see what happens. And I tell them, hey, like, honestly speaking, it's probably not the right move, right?
Yeah.
It's better to take these if there is a dip in the mortgage rate market or whatnot. It's better to take it when you can, right? As often as you can, and then just ride it out and cost average down, if anything. If the true belief is that mortgage rates, which I think over the next 2-3 years maybe might decrease a little bit, right? But we're not talking about a shoot down to where we were maybe 4 years ago, right?
Yeah.
So I think the expectation that listeners and people just need to have is rates are here to stay higher for longer a little bit. If
Mm-hmm.
you like it, lock it, and just kind of cost average down and make sure you're making your investments based on today's situation, not later.
Yeah. When I look at the risk equation, I've personally, I don't know if this is the right way to do it, just how I roll. I'm always looking to protect the downside, not the upside, right? Let the upside run, but my job's to control the downside. And today, all of the downside is higher rates. So your comment about if you like it, lock it makes total sense to me. I'm on record saying that mortgage rates are going to average close to 7% in 2025. And again, I don't see that as a bad thing. I mean, one of the things that we're going to talk about 2024 is just the gyrations. I suspect 2025 is going to be much more of a normal mortgage year where the variations are within a much tighter band. What do you think about that 2025 being in a tighter band than 2024's wild ride?
We would love that, as crazy as that might sound, to have rates stay at 7, being in our industry, right? Because of the fact that we do need the market to, and it's the housing market, but it's also the consumer sentiment that you touched on 2 minutes ago. We need that to stabilize. We need that to normalize in terms of, like, we had so many people waiting on rates to drop. And what happened in September through October when rates dropped? Well, they thought it was going to continue to drop, right? And then it stopped and it shot back up. And to see the, like you've touched on, the applications that at least Convoy's been getting, our real estate agents that we partner with, if you were to tell me that we had more applications when rates were up a full percent than they were down a full percent the month before, you'd be shooting yourself in the foot saying, what do you mean, right? And that's the biggest thing is I think going into 2025, if we can have a year of some sort of narrow trading in terms of rates, the bond market, et cetera, it'll give us a chance to heal before we can start seeing any sort of, reduction in rates.
Yeah, again, as somebody who's studied the consumer for over 30 years now, they are remarkably predictable. Remarkably predictable. And what do I mean by that? Well, when we saw rates collapse from 8 to 7 and 7 ultimately down to a low of 6.11, that downward trajectory was so consistent and so, I don't know, I'll call it large, right? Big moves, like steps. We're not talking drift, we're talking steps lower, that the average consumer predictably, in my opinion, was going to hope for it to get below 6. It's like they look at the chart, it's only one direction. They don't understand the big picture. They don't understand what's being priced in to that 6.1 and what's the risk. So it actually doesn't shock me that you're busier at 7 than you were at 6.1 because consumers are so predictable. Oh, it's pretty funny. But yeah, so is that what you guys saw? You saw a lot of people going, I'm going to wait. I'm going to wait for 5.99. I'm going to wait. I'm going to wait. Is that what you guys were seeing?
Yeah, absolutely. And this is even more so when we were talking to clients doing, buying down at 5.25, 5.5, right? Like 2 months, like what, 2 months ago.
Mm-hmm.
And we were telling people like, hey, like this is the time, like let's get moving, 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 moving. And they were like, well, I feel like if FHA is touching somewhere in the high fours and you can get there, and DSCR, you guys are getting 5.5, 5.25. I think if we wait a little longer and after Trump's elected, it's going to go lower. And I said, that's probably not going to happen, but you know what? You got to make your own decision. That's fine. And what do we see happen? It just shot up, right? So I think everyone that missed from that initial shoot, everyone that missed that boat is now coming back and saying, I should have done it back then, but here I am now. I just have to make a move, right? And they're kind of taking more what's available instead of hoping for something that's unrealistic.
Yeah. So let's do a quick review of Convoy 2024 before we get into what's coming in 2025. When I look at the year, especially in mortgage, the year was one of high variance. We saw some pretty violent moves, especially in the first half of the year. You guys are in the business and you've seen all of it. If you were to summarize 2024, what would you summarize 2024 mortgage as?
I mean, in terms of a rate perspective, I'm just going to throw this in, and this is why it'll sound like there was so much variance. But going into the year, we rode, let's just say, average 6, 8, 7%, right?
Mm-hmm.
All the way through to a little bit of an uptick of maybe an eighth of a quarter point until July or August. Then you have a full percent drop for 1 or 2 months, right? And then we're back up to 6, 8, 7%. So most years you don't have a 1% drop for a month and then go 1% back up. But that'll tell you that it's been a fun ride. It's been fun to see, the amount of applications come in during which rate levels they were at and why they were coming in, whether it's the spring buying season, whether it's summer, whether it's optimism that rates are going to keep going, or now it's FOMO because you missed the drop. So it wasn't a dull moment in the mortgage industry, to say the least.
Yeah, the one thing that I think 2024 will be highlighted for is we now know with certainty where a refi boom kicks in, right? There was a let's maybe call it 8-week window where refis were up triple digits. We're talking 112, 140%. So I think we know with certainty refis kick in hard at, let's just call it 6%, which is maybe data we could have guessed, we could have assumed, but I think we now know with certainty where a refi boom kicks in, and it's at 6%. Does that feel about right?
Yeah, absolutely. And I mean, I don't feel like we are, even if it's a high 6 handle, right? Anything, I think it's just six in general with a six in front of it without buying it down. I think that's where people start really moving the needle because then it's like if they have a six right now, it's kind of still worth it to take some cash out. Or if they're high fives, like, hey, maybe just take a little bit of a higher six to, get some cash out. So I think there's a lot of variance in the six, but 2024 was probably the most creative year of mortgages, I think, in terms of the way that people got resourceful and clients got resourceful. And, we were guiding clients through kind of the same situation. I think that's what yielded to a lot more transactions than before. Yeah.
Yeah. So the other thing that I think about Convoy specifically, again, you guys do conventional, but you do a lot more DSCR. You are the one-stop shop for investors. I think it's been the last 3 months. It might have been the last 4 months. Both of you have been telling me, Michael, DSCR loans are within an eighth. And I think there was a couple of weeks we spoke where DSCR loans were better on rate than conventional. A, where do we sit today? And B, do you see that potentially continuing in 2025?
Yeah, right now, as of today, we're pretty much on par, but believe it or not, now DSCR is actually about maybe zero point 0.1 on average when you're comparing just let's just say your typical 4 unit purchase, 720 credit. But we're comparing on the DSCR side still a loan that's with a 3 year prepay. And what we've seen kind of shake up, which is very interesting, but a bit scary for me and John's position because we haven't told anybody in your community or even you yet, is look, one of the biggest loan buyers on Wall Street for all of DSCR non-QM loans put a pause on buying. Told us this on Monday. Throughout the end of the year, when they're coming, they got their full load. They're waiting to see 2025 what truly transpires, and if they come back, we don't know, but it's a void that we have other options. But they were one of the best, at least for mortgage rates that the consumers see, the best loan buyers out there on Wall Street. And for them to say that they're pausing and maybe coming back January 1, maybe not, gives a little bit more time for me and John to discuss what sort of pivots in 2025 we might have to make.
Wow, this is going to be a fun conversation. Again, folks, remember, you can ask questions. I currently don't see anybody with their hand raised. I see a couple of comments, but no real questions. Shout out Ryan for always being there, helping out. Ryan, thank you, buddy. You guys can put in questions. Otherwise, you're just going to hear us riff. And hopefully you're getting value from this. And hopefully you're having fun. So, all right. So let's talk about this biggest mortgage or Wall Street buyer. They've completed their appetite for this year. They're stopped buying. Not a big deal, right? Couple of weeks left in the year, but no promises of coming back next year, or if they're coming back, at what terms or rates or whatever. That's interesting. It could be a nothing burger, but I'm going to have fun thinking about this for a minute. So, again, I don't know who this is, and I don't want to know who it is, but is it fair to say that generally speaking, Wall Street buyers go in a herd? Typically, there's a lead dog who, when they pivot or move, other lead dogs follow? Or are they all alpha males or alpha whatevers and they all do what they do? And, if one person goes out, maybe somebody steps in. What are these? Do they move in a pack or do they a bunch of lone wolves? What do you think?
I don't think they're lone wolves because I think one triggers it's like a domino effect. And we saw this happen if you remember like 2 years ago, once 3 years ago, right? When DSCR
I remember.
Yeah,
I remember.
and we always tell clients like, hey, this is a fairly new product, right? Still. And Wall Street and the market is still digesting how to calculate the returns, calculate the risk. And there's not enough of a long enough track record to ensure that it 100% stays, right? So we tell clients like, hey, if people are guaranteeing that DSCR and these loans are going to be around for forever, right? They are grossly incorrect. And the reason is because if people like this, like extremely big buyers, leave, that means that everyone that was selling to that buyer no longer can sell to them, which means that all these shops that had them as their primary buyer are now left holding the bag. And if they're left holding the bag, they're going to offload it for pennies on the dollar to other buyers on the street, and other buyers will maybe take that loan. And then when they take that loan, they'll package it up and they'll say, well, this isn't good. This isn't a good package.
Mm,
And if they start doing that, then other buyers are going to start saying, we don't want these packages. And if that happens, then at a certain point, the loan is gone.
right.
Yeah.
So okay, I'm going to keep playing this game because I like to play it. So this big buyer, again, I'm not going to ask this specific of Convoy because that's not a fair question. But as an outsider, a complete outsider, is it fair to say that some providers similar to Convoy might have had this buyer consume 50% or greater of all loan production? Are they that big, or would they never be more than 10 or 15% of someone's shop?
No, so this loan buyer on Wall Street, there's some shops out there that sell 90 to 100% of their loans to them.
That's what I
Okay.
thought. Okay. So that's question one. Okay.
Yeah.
So I assume that, but I wanted to get that on record. So there are entire companies doing loans, DSCR loans today, that their whole pipeline was to this end buyer. That end buyer has now said, I'm full. I'm out. I'm no longer at the table or the buffet or whatever you want to call it. So these loan providers now have to find a plan B. I think best case, these plan Bs are going to take a haircut. Because again, this biggest buyer, they had the biggest appetite. They had the loan, they had published rates. They just ran a shop that just kept feeding them. Now that they're full, they have to find plan B. And again, you and I saw this, what was that, 2 or 3 years ago, right after Silicon Valley Bank went kablooey? We saw a bunch of mortgage shops blow up because their end buyers were gone. So it's we might repeat the same thing. So if I play this out from memory, there are going to be some loan providers, mortgage providers, who go out of business probably very quickly because their loan books are worth 80 cents on the dollar or 85 cents on the dollar. That's bad. There are going to be operators like me who have pending loans with these providers that are going to get left at the altar because there's no funds to fund. And as I recall, that was the time that the DSCR loans shot up like 1.5%. Because again, there was a void in the market. So you had to go to someone who had less risk. So you had to pay more interest. Do I remember that dominoes right?
Yeah, absolutely. And then the step after that, which is the most scary one, is they just stopped.
Yeah. They
And
stopped.
at a certain point in time, and anyone that's new to the DSCR non-QM market won't remember this, but like Dustin and I have been through probably like 2 or 3 phases of these scares, right? And the scariest point I think was 2 years ago or a year ago. I can't remember how many years ago it was, but where they stopped, and we were like one of the last providers of
Remember?
non-QM DSCRs just on the market. Everyone else just paused it entirely.
Yeah, it was like 3 or 4 months. There was nothing
Yeah,
available, and the stuff that was available was so grossly priced that it basically wasn't available.
exactly. And I mean, not saying we're gonna head there, right? Because everyone still has a positive outlook on the market, but we'll see because this is almost like a statement made
Yeah.
on the street that, hey, there's a little bit of blood on the street right now, right? We're already hearing it
Yeah.
from people coming back to us and saying, hey, um, we can't operate. Essentially, they're telling us, shops are telling us we can't operate,
Yeah.
right? And
Yeah.
they're asking us to help them place their loans. And, and we're saying, hey, like we don't have the time to do that, but like send us what you have. And we're seeing these things kind of come through.
Hmm.
And it's a lot. It's kind of scary to see, right? And on top of that, there's another scary point that I don't think we mentioned, but defaults kind of quietly are up.
Oh yeah.
And that's I think the biggest trigger to why people might exit the market in this sense.
Well,
All
so
the
so that yeah,
yeah.
so because this is exactly where I was going when I looked at the chessboard and the operator pulling back. I think what the operator is telling us is, well, I'm going to say this is more of a hope because who knows. But I think what we've learned, or what this operator has learned, is DSCR loans are a valuable option for folks. I don't think there's any question. There are plenty of reasons to do DSCR loans over just having conventional. So I think there is a market. And I think it's a big market that someone needs to operate. But what I think happened and what's going to burn providers, at least in the short term, is two things. One, they didn't underwrite the risk appropriately, right? DSCR loans, rightly or wrongly, could have more fraud in them than a conventional loan. You know, there's just things that could be done in a DSCR loan. I think DSCR loans, in totality, are probably riskier loans than conventional loans. And as we have talked about, I think for 90 days, the spread, which AKA is risk premium, has been basically nothing. So I think providers or buyers, specifically buyers of DSCR loans, got a little too happy, a little too drunk on a new line of business. They didn't understand the risk because, as you guys know, real estate risk is not recognized in months or quarters. It's typically years before defaults happen. And now they're looking at the end of 2024, planning for 2025. Defaults are showing up. And I think we missed this, or I missed it until right now. They probably have been pricing in rates falling, and they now are realizing rates are going to be higher. So they just have to pull back. They have to reprice risk. They have to reprice higher for longer. So my guess is they come back, but it's at rates nowhere close to where they were when they exited. Do I have that picture possibly right?
Yeah, that's definitely one of the options, right? And what you said is they're constantly, when Wall Street's providing what rate should be offered with the risk premiums that are going to be allotted to any sort of loan sellers that they'll be the buyers on, right? They're doing that every single day. What's different when you're talking about a conventional loan, these are going to be mostly based off the treasuries. We know that the risk isn't as much, at least me and John fully believe. Like, there is, and I'm not saying anything about Convoy, but there is definitely ways for the entire DSCR blanket industry, anybody writing a DSCR loan, right? There's a lot more potential issues for fraudulent, whatever
Oh
it
yeah,
might be, than on a conventional side.
of
And what's
course.
funny, if you look at it, like when DSCRs first kind of popped up and was really popular, 3.5, 4 years ago, there was a bunch of 85% down, 15% down purchases, DSCRs. There was a bunch of 80% cash out on 4 units, right? And those are just as high, if not higher, than what somebody could get buying their first time home, right?
Exactly.
And when you saw that now all of a sudden go to, okay, the max you're going to be able to get now is 75%. There's probably right now in the market, we get a lot of calls like, can I do 80% cash out on my, DSCR loan on investment property? I'm going to guess there's probably 5% of DSCR loan providers out there that even have that on their rate sheet, whereas 95% of them don't even want to, talk about it because it's not there. Whereas 3 years ago, 100% of DSCR lenders had the 80% cash out. And that's all because Wall Street's starting to learn the game. They're seeing what,
Yeah.
loans are defaulting. They're taking those off the table, and they're seeing which loans are too high of rates. And now they can't, go on and make a premium. So that's why they're, cutting it. Like we just said, this loan buyer is realizing the margin and the risk don't add up. So there's no reason for them to continue at these levels.
Yeah, so I think at the end of the day, again, I think if the big buyer is doing this, they're not lone wolves. Others will follow. I mean, I see it. I talk to people. I know what's going on. I think DSCR loans are certainly defaulting higher than conventional loans. I don't think there's any questions if you look at the loan books. Um, so I suspect in 2025 that DSCR loans will be available. I think the 80% LTV is just not going to happen, whether it's purchase or cash out refi. They'll go back to 75. But I'm just going to make a wild ass guess, which I love to do, that DSCR loans will be no better than half a point more expensive. And I think there's a good chance that when the product comes out, it'll be a full percent higher. Like if conventional 7, it will be 8. And maybe over the year, the spread comes in a little bit because of competition. But I think the days of DSCR loans being priced better than conventional are just flat out over. What do you think, Jonathan?
I mean, we'll see how everything kind of pencils out because we're still seeing right now in today's market like them being pretty much equal or
Mm-hmm.
sometimes in some cases below or higher. So we've seen this story happen a bunch, right? I think there's going to be, well, we already saw someone else step in, another player step in and kind of tolerate a little more risk and be able to, write the loans and not as much of a spread. So I think people are going to step in till they step out. It's more of a question of how many people will step in to fill the holes until no one's left to step in anymore and
Right.
they all step out and then they go to what you're talking about, which is, the spread is now 1% from a conventional loan, right? I don't think it'll be it won't be like a tomorrow thing where
Right.
that spread happens. It'll be over the course of the next year. How does the risk lay out? How many people are defaulting on it? How many people are just, not paying their loans off at all, like any payoff of these loans? Like what's that number and how's that compared to how much risk they've already built in? Who's stepping in, stepping out, step in, step out? And I think we're gonna see that dance happen over the next year. And it's kind of like a risky place to be overall, I think, in terms of the market, because it means that we're not as stable as we think we are, right? In terms of like an overall real estate market. Because if real estate's great and everything's perfect and everyone's making their payments, like we're not even having this conversation. But everyone thought everything was great. But what's the actual, underlying disease that's, rotting the corpse
Yeah.
from the inside, right?
Yeah. Yeah, it's going to be really interesting. I think there's no question that there's some acute pain in parts of the market. The one that always jumped out to me, and we talked about 6 months ago, is kind of the Airbnb market, where a lot of people got in calling it a owner occupied loan, and it never was. It was a complete mortgage fraud. And then there's been other areas that maybe they did the right thing in the right loan product, but the cities or counties changed the rules and have now made those Airbnb properties unprofitable. And I know a lot of people who bought Airbnb properties and that was their only way to survive, right? If they stuck in a long term rental, it would be an alligator, as I call it. So I expect there's a lot of pain in those areas. Um, I don't think it's going to be enough to affect the overall, housing market, but it certainly can impact different loan books, right? If you have a loan book that was in Palm Springs, for example, oof, there's some serious pain going on in some markets. So that's interesting. Um, let's do something for the audience because we just jumped in talking about conventional and DSCR. Why don't we define or give people samples of what's the difference between a DSCR and a conventional loan, both from time, paperwork, all of those things. So let's not assume people know the difference. If I'm a one-time investor and I'm buying a fourplex, what does a DSCR loan process feel like versus a conventional loan product feel like?
So when I'm first giving a quick summary to any new client that I speak with, you're going to imagine both of them are identical processes in terms of there's going to be an underwriter. There's going to be an appraiser that goes out to the house to make sure that all the windows, and roof are intact, right? Everything's going to be the same. It's not going to be just an easy breeze like a hard money fix and flip. Don't ask any questions. Here's your 12% rate, right? The biggest caveat and the biggest difference is that on a conventional loan, we are going to ask you for every single personal income documentation that you have that applies to you. So your W-2s, your pay stubs, your 1099s, your tax returns. And mostly if you're self-employed or you own other real estate, right, your tax returns are going to be the number that we look at. And when I say that, it's important because we're looking then at your adjusted gross income. And as most people know that are self-employed or own real estate, you're going to pull every lever in the book to either write off depreciation, what have you, so that your taxable income is as low as possible, which when you're applying for a loan doesn't work
Not
well.
good.
You want to show as much income, right? But on a DSCR side, we throw all of that out the window. We don't care about, what your taxes show. We don't care about your W-2 or your 1099 income. What we care about specifically is how much can you rent this property out that you're trying to get a refi for or a purchase for? Will the rental amount be higher than the mortgage payment that we can get you? Because if it is higher, then we feel good because now we know there's a tenant that is willing to pay you more than what your mortgage payment is going to be to us. So we feel good about that. And that's the biggest, thing is there's a lot of people out there that just have a lot of money, bring in a lot of money, but on taxes show nothing. So they can't get a conventional loan. You do a DSCR loan, and this could fall into a bank statement type loan too, but DSCR loan, we don't care about that. We just want to look at the property and ultimately make sure it's cash flowing.
Yeah, I love that. Let's add one more element. A typical convention loan cycle to get to approve eligible is 30 days, about right. And DSCR loans could be certainly less than that, maybe 3, because where I sit, DSCR loans are faster, but maybe that's just because who I am. You guys tell me, conventional versus DSCR timeline?
I think they're about the same. I
Oh, really?
think,
Okay.
yeah, I think they would end up being like 30 days or less in both cases. I mean, conventional loans, if it's a clean file, obviously we've closed in, less than like 14 days or less. But if you're talking about DSCR, sometimes it's 21, sometimes it's, 30. So it really just depends on like how much massaging, how much hands need to be in order to make the deal work. Excuse me. I think that's going to be the main thing, but 30 days is pretty standard.
Okay. All
Yeah.
right. I like it. I like it. I guess I just get special service because I get my DSCR loans done in about 2 weeks, but that's okay. That's just good for me.
You're
I
you're
like
on a
it.
different plateau than most.
I get a different level of service. I'm okay with that, frankly. I like that. So we do have a question from Renee. Again, folks, if you have questions, put it in the comments or raise your hand. These sessions in school are for you. You get to talk to the people I get to talk to. Renee asks, does anyone refi a DSCR loan to conventional loan? Does that ever happen?
Yeah, I mean, we've done it a handful of times, right?
Yeah.
And a lot of the reasons sometimes is because maybe somebody got a DSCR loan 2 years ago at 8.5, right? But they were fortunate enough, or whoever they were working with, or they decided I'm going to get a 1 or 2 year prepay or something like that, right? And then the conventional refi 2 months ago, you're going from 8.5 to 6.5. But a lot of the times, if you're refining from a DSCR to a conventional, it's not for what that example I just made to get anything other, than a better rate. You're not going from from DSCR to conventional to get more cash out, to get a higher leverage. Because right now the conventional side is going to be lower on leverage across the board, whether you're talking cash out or purchase on a 2 to 4 unit or a single family, you're more normally going to see like I said, a convent or DSCR loan being refied into a conventional loan for rate purposes, not for like cash out or leverage purposes.
Yeah, let's talk about refi cycle because Renee asked a great question, but I think there's even a bigger question there. You guys told me the other day when you talked about I think it was your October business, it might have been September, that you saw a pretty large uptick in refis. And these refis, when you looked at them, were really kind of the step above. They were coming out of hard money, which I'll call 10, 11, 12, and they couldn't get out of their projects in time for whatever reason, delays, market condition, blah, blah, blah. So these operators' decision was to go from hard money at 12 to DSCR at 7.5 to kind of buy themselves time. And then that allowed them to maybe limp along as a long-term rental until the market got better. Do I remember that one step correctly?
Yeah, absolutely. Yeah, that I think a lot of people did refis into that, but also is for seasoning too, right? Because DSCR seasoning is less than
Less, yeah.
conventional. So a lot of people that were doing these bridge loans or hard money loans at 10, 12%, whatever, and they fixed up the property and they were like, I don't want to pay 10, 12% or even try the market. Just flip it over to DSCR after 3 months, and then go on a
Right.
long-term basis there. Yeah.
Yeah, season is great. And then to really close out on Renee's question, if you're going to refi a DSCR loan, or frankly, even a conventional loan, or we'll start with DSCR, that's just going to be for better rates. DSCR loans, at least until today, you would get more leverage, meaning 80% versus 75. The rates would be roughly the same. Typically, you're going to have prepays on the DSCR when maybe you don't on conventional, or at least an additional year. So that's kind of the refi cycle as I see it. So we do have another question from Mary Jane. Again, thank you so much for putting in questions and comments, because again, I do these live sessions in school for the community. Mary Jane asks, what is the typical down payment on a DSCR loan? Let's do purchase and refi.
So the typical, and I think both John and I say this pretty much the same way anytime we're speaking to a client for the first time, is there's really a line drawn in the sand on purchases between 25 and 20. Now the caveat is that with 25% down, you're normally going to get a rate that's 0.5% better. Okay. But we know on DSCR loans, especially on a purchase, it all comes down to the appraisal. What does the appraiser put down for the market rent? Okay. And if you're doing 25% down, you don't have to worry as much about being able to get the keys to purchase the home. Okay. Because even if the rents come in lower than a 1.0 DSCR, and you're putting 25% down, we can still get you the keys, but the rate's going to be obviously higher than if the rents came back above 1.0. Okay. But
So
the
I want to hit that
is if you're
real
shooting
quick.
for 20.
One thing I just want to hit again, because I don't think I heard it. I think a lot of people missed it. It's what the appraiser puts down for rent. A lot of people hear appraiser and then they tune out because they only think about the appraisal value. If you're getting a DSCR loan, the appraisal rent is equal or maybe even slightly more important. So I just wanted to hit that because I don't think a lot of people caught it. So keep going.
Yes, the what the appraiser does on a DSCR loan is twofold, unlike a conventional. They're getting us the value using the sales comparison approach. What's the value of the home? But they're also telling you how high the rent should be or what the market will be according to them. And that's what DSCR underwriters are going to use to calculate, is this property going to be cash flow positive or not, right? But on a 20% down option, if the appraiser doesn't put rents that are high enough to cover, then you're not putting 20% down. There is no ratio below 1, 20% down. You got to go to 25. So if you're going into it as an investor and you're like, I only have 20% to put down, well, you better have a long 3-week due diligence contingency on the appraisal, because the appraisal doesn't come back high enough and you don't have enough to put 25 down. The keys aren't going to be yours.
Yeah. And this is why I think there's a lot of Airbnb pain coming, because you and I were talking like 18 months ago about these STR DSCR loans, right? Because they were using these, I forget what the AirDNA, I think was the application people were using to kind of show. And that's the only way these loans got done. There was no plan B. And I think a lot of that stuff is blowing up because AirDNA was wrong, or the city changed, or whatever. And I think I think when we do a post-mortem in a couple of years and we break down defaults on DSCR, I am willing to bet $1,000 that more than half the DSCR loan failures or repossessions, whatever, were STRs gone bad. It's just, we had these conversations. We have the videos, and you guys were telling me they were using this AirDNA thing. And I'm like, oh my God, that's like the most rosy outcome you could possibly think of. Nothing could go wrong. Yeah, right. That was crazy time. So do I have it right?
We're still, we're still doing AirDNA for some markets. So it's still around. It's still something that people are doing. But I think AirDNA itself has become a little more conservative. I think AirDNA itself has become conservative. I think maybe they got in trouble or something, but their numbers have been a little more conservative. Yeah, especially because AirDNA sometimes would pop out approvals in markets that didn't even have it approved. You can't do Airbnb, but they'll still give you a number, and and people are writing loans that way.
Yeah, I saw
Which,
this problem 18 months ago. I'm like, this like when you don't have plan B and the income rent in this case was astronomically higher. I'm like, this only has one way it could go. I mean, this is only
yeah.
downside. So it's wild to think about. All right, we got some more questions. This one from our boy Ryan. How does the ratio considered? Does a rate compound, i.e., a 1.7 to 1.5 is better than a 1.5 to 1.3? Like, like you already talked about below one, you're not getting the loan, but like, do rates get equally better the higher up that number goes?
So the biggest line in the sand is just being above 1.0, right?
Okay.
Now, the most common amongst all loan buyers right now on Wall Street is they'll normally give, a very, very good rate above 1.0 on the DSCR. And then they'll give that extra tier better pricing at a DSCR above 1.25. Okay.
Okay.
That's just the most common, but there's a lot of loan buyers out there that'll do a different price if it's above one, a different price if it's above 1.1,
Mm.
1.25, and 1.5 is the highest. There's no like,
Okay.
oh, if you're at 2.3 or something, great, but we're not giving you that much better of a rate, right?
Okay.
But the thing to note is the difference between, let's say, above one and above 1.5 DSCR, it's probably a quarter point better on
Hmm.
rate. So it's not, the same difference between 0.98 DSCR and 1.01 DSCR is three quarters of a
Vastly
percent.
different. Yeah.
So
Yeah.
that's the line you want to be across, it's just above one.
Yeah. Yeah. I think that's very helpful to the group. Ryan does say this. I just thought I'd throw it out there. I thought it was pretty cool. Ryan considers YouTube to be the ORAT community and school to be the ORAT family. Oh, we just give a big aw. You're so nice, Ryan. All right, here's a question from Renee that I think I know the answer to, but I'm going to ask you guys. Is there a limit on the amount of DSCR loans you can get historically? I have seen times where you can only get four Fannie and Freddie. I think today it's 10. Is there a limited DSCR loans?
No, there's no. We have an option to move it because we have so much money on the market that is a lot of investors in the DSCR space still buying. So
Mhm.
if there's a limitation to one lender, we can always move it to a different lender. There's a lot of different options. So we have clients with portfolios of over 100, DSCR loans. Yeah.
Yeah. So again, what I would tell just a normal operator is if your particular loan buyer doesn't want your loan, there's another one that does, right? Fannie and Freddie has a clear appetite limit, but the DSCR loan world is there is no limit. So yeah, like you said, up to 100. Let's see. Okay, good. All right. I think I've got all the questions. Again, folks, we've got time for maybe one more question if you want to sneak it in. We haven't really talked about 2025, but we'll do that now. What you in the next 5 minutes, guys? Why don't both of you give us our thoughts on lending, ease, rates? What do you see for 2025?
I think I'm going to retouch on what we've been saying the past month or so is that I firmly believe there's going to be, a much narrow trading margin for rates hovering 7% for all of 2025. I'll go out on a limb and say that there's not going to be more than one, if not zero, Fed cuts in 2025. I think we'll have a more stable market. I think it'll be a market where a lot of consumers, or pardon me, a year where a lot of consumers will come to the table and realize where we're at. But I don't anticipate any sort of wild changes in the rate market, which I know is the most important topic for consumers, at least until 2026, middle of 2026.
There you go. I like that. Jonathan, any other color you want to throw on that?
Uh, I mean, I completely agree with what Dustin says. Um, I think the best thing that you can do is obviously, like we've been saying, just underwrite it based on now. Underwrite everything based on now. Be conservative. It's better than being aggressive, right? If it works on a higher number, then it'll work on a lower number. So just make it work that way. And just don't expect I think the expectation just needs to be removed from people's minds that rates move normally, right, that much in 1 year period, right, up or down. We've been in a very unprecedented market after COVID, after the Fed stopped buying bonds, all that stuff, right? So there's very little motion that typically happens in a rate market within a year span. So just kind of normalize again. Hopefully 2025 will kind of get people in that mindset again, that rates don't do what they did the
Yeah.
last 3 years. And I think that'll definitely change the perspective and the deal flow for a lot of people. And if you like the deal and it works right now, it's going to work even better when rates are better. So
Yeah.
just take the jump on the asset first, and then you can worry about refinancing the rates later into better cash flow.
Yeah. So at the end of the day, what I would tell folks is I still believe we are in a buyer's market. I do think that inventory will grow 5-10% next year. If you're a part of one rental at a time, disrespectful offers, 30-year fixed rate debt, make sure it cash flows day one. You only get upside from there if rates go down sometime in the future. We're going to have more choices. I do think it continues to be tough for first time home buyers. So affordability is not going to get much better, if at all. So again, I think it's a year of where doing the work pays off. It's certainly the first 6 months. It just kind of feels like we're heading that direction. And then at the end of the day, folks, remember that Convoy is the lender for investors. They have all kinds of different products. They are the guys that you should go to if you're part of one rental at a time. They do offer the most things, and they review the files and they tell you, no, you shouldn't do this. This is an alligator, which I greatly appreciate when I get those emails that you guys told somebody no. I know that's turning away business, but it just makes me feel good that you're a part of this. So where do they go to start something with you two guys?
Yeah, go to convoyhomeloans.com and let us know you came from Morat.
So there's a little drop down window, right? On the form, you say where did you hear from us? One rental at a time is in the drop down, correct?
Yep, correct.
All right, guys, go there, because if you're watching this, you want one of these two guys to help you. And that drop down list is important. If you do not select this, you're a fool, because you will just end up in this queue of all the other plebes, and we are better than that. So go to convoyhomeloans.com, click on one rental at a time, and either Dustin or Jonathan will help you out. Guys, take care. Thank you for doing this hour inside school.
Thank you.
Yeah,
Later.
thank you.
Bye.